Welcome back for another week in review. This guy's gotten over Rona, so we're going forward for another week. And we have a few things on docket. Obviously, you're going to look to what happened last week, look forward to next week. And then we also have a few little stock reviews, everything from airlines to healthcare. So if you guys want, you can skip ahead. I'll leave all the notes and everything for the timestamps down below. So as we talking to last week, kind of one of the things I was looking for was obviously Megacaps. Specifically kind of Google and some of these guys, what their price action was going to be this week. Last week, obviously you had massive selling pressure. We kind of discussed that. Google and specifically were down 8% just in a week, which was way larger than the S&P. And obviously it's a very large component of the S&P because it's a weighted index. This week we saw the complete reversal, which is good if you're looking for stabilization and maybe a little bit of bull case going forward. We saw kind of actually a 10% rally. So not only did we recoup the gains, we also gained a little bit going forward. Apple going forward too, which is the first time we've seen this in a few months, closed above its 50-day average for 2 consecutive days in a row. We haven't seen that in a few months, which again is very positive, which means the momentum kind of has stabilized and kind of turned positive recently. Obviously, we're kind of going to discuss that in a later segment, but for now, things look to be holding steady. Everything's kind of threading the needle.
Why would you say those stocks bounced so hard? What's the overall sentiment based on?
It is not at all had to do with sentiment. If you looked at last week's video, I kind of cited that I was looking for maybe a kind of like a 5% gain going into the next couple weeks for the S&P. It's just had to do with where we were. We just seen too much blood, too short a period of time. And you also look at everyone right now is freaking out, but if you look at a lot of the data points, yeah, we're having a little bit weaker ISM and we're having some weaker data points on just a couple different readings. But as a general rule of thumb right now, you're still seeing positives. A lot of everything that's been negative has been chatter and sentiment. So that is enough to drive the market down. But when you're looking at where we were, it wasn't enough to really bring any forward. And kind of just saw us being able to, with a short week, there's not really a lot of heavy information coming in. Sentiment kind of got too bearish, too quick. And then we had a couple little readings that came out that were slightly positive this week as well. So it's just kind of a consolidation week, which is what I was looking for, kind of coming into this week, and that's kind of what we got. So
here's the real question. Is it a dead cat bounce, or have we found a bottom?
Yeah, I mean, let me consult my crystal ball over here. Let me get that. I mean, right now it's kind of the obvious has happened, right? So coming into January this year was definitely bearish. Set myself up accordingly. So knew just based off just valuation that was not correct. Where we were sitting at wasn't sustainable, wasn't correct, wasn't accurate. Very simply, up until now, we've had kind of a correction in valuation with kind of a very with kind of like a small percent chance of recession priced in. Now, whether we have recession or not is what everyone's obviously talking about, and that will ultimately decide kind of where things go going forward. Even if we don't have recession, if we have kind of like inflation eating into earnings margin and stuff like that, that's kind of the discussion everyone's having. And the obvious to the downside has been taken, and right now we're kind of in a wait and see mode, I feel like, where it's really going to depend on what the Fed and what a few other factors kind of we have coming in. If the Fed comes out and they say we're going to do one last 75 and we're going to stop, it's going to be a completely different story than if they come out, they do 75 and say, hey, we're still looking at another 50, at the next meeting. But, trying to guess what the Fed's going to do is, in my opinion, fool's errand.
Right.
So right now I'm just kind of taking them at their word. Right now we're sitting at key technical levels. And I think next week, unlike this week, I think next week you're going to see a lot of volume and a lot of volatility and kind of fireworks, either one side or the other, based on the data that we have coming in.
I agree. I think I can. So just as a recap from last week when I introduced myself, I don't review this stuff nearly as much as Justin here. I'm more on the real estate side. But from the little bit that I was paying attention to on just stock news and what's going on in the markets, I definitely see it possibly going either way. And there were some kind of key points that I highlighted in my mind as to why that could be. One being if the Fed, again, like you were saying, comes out with a 75-point hike, right? The market's going to bleed. No doubts about that. If they come out with a point or a 50-point hike, then at that point, I think probably the market would rally because it's probably what they expect. And whenever it's something expected, right, it gets priced in or whatever it is, people feel better. If the Fed has a 50-point hike and it's what people expect, right, I don't necessarily see the market bleeding at all, even though it's a 25-point difference. And I'd probably rather see it bounce, and I would love to see the market bounce. However, so what I'm expecting is I saw that commodity pricing was falling heavily. Commodities have obviously been on an insane rally, and they've also likewise recently been on an insane plunge. And commodities is usually one of the first things to take a hit when it comes to what is inflation going to do. It's kind of, commodities is kind of the first indicator of what inflation is going to do. And what's going on in the commodities market looks like it can actually be kind of like a little bit of an anticipatory signal as to inflation possibly being transitory. Now, I find that a little hard to believe, only because printed so much money, how could it possibly be transitory? But I'm hoping it's transitory.
Well, to bring some data to that, we've RBOB, which is basically direct input for gas, basically is your refined gas, if you will. It's down, I want to say like 23 in the last 25 days. Again, don't hold me to that exact number, but you're down roughly 25% from the peak. So you've already started to see kind of basically the extremes being taken out. And part of that is because unlike land or something that's finite, right? Like Bitcoin, the whole thesis behind Bitcoin is there's never going to be more than what there is today tomorrow, and it's a finite quantity. Oil is not finite. Exxon right now is drilling more oil than they ever have in their history. So again, that to much to the begrudgance of their equity investors, they are. But so that kind of again is where equity investors kind of have to play that out. It's not like Bitcoin where it's purely a play on supply and demand, because your supply is fixed and your demand is the only variable. In oil and some of these other commodity industries, you have obviously more than one variable. So it's obviously a moving target. It's very complicated, and which is why you have so many people on differing aisles.
Yeah, because I see both sides, but I think it gets a little more nuanced too, because oil is a little bit tougher, where you obviously have these huge conglomerates that control supply to such, a fine degree, right? That's
kind of a misnomer, actually.
Really?
Because again, and this goes back to when I was looking at, not to get into oil tangent here, but I guess we kind of have. When I was looking back at kind of like the equity specific, like the refineries and some of the services and stuff like that. If you look at Schlumberger, Halliburton, it's kind of a duopoly in that field. Schlumberger actually plays a lot more to the smaller players, the explorers and the guys who are adding the last barrel of supply to the market. A lot of your Exxons and stuff, they have massive projects. They're not chasing kind of like the more marginal stuff. And if they do add, it's a little bit different. So long story short, these guys are going in and they're actually being very aggressive right now, which is why kind of when I was looking, again, getting back to just this specific scenario, when I was looking at, Schlumberger and Halliburton, between the two, I was actually looking at getting more exposure to Schlumberger because they have more direct exposure to kind of the shale and the new discovery side of oil. And even though they don't control the largest supply, it's not like it was 120 years ago when, I can't remember his name off the top of my head, but one of the first billionaires basically controlled U.S. oil, right? Because it was one company, and the U.S. was essentially the only market in the entire world that had the technology to produce oil, right? Now, they drill oil. That's another thing too. People are anticipating basically from January of this year to September an additional 2 million barrels daily of oil supply coming on between Brazil, a little bit of Central America, and obviously U.S. and Canada. So it's not really, from an actual investment standpoint, it's not a controlled market. There's attempts to, even if you look at OPEC, right? So OPEC plus only controls roughly a quarter of the entire oil market, which means they're not, even all those nations combined are not a majority player. So to say it's able to be controlled, I would kind of push back a little bit on that, and that's kind of why you see actually the price of oil in real dollar terms has actually just fallen the last 100 years. And this is why I don't ever recommend oil equities to individuals, is because let's take, for example, 3 of the biggest entire U.S. Producers of oil and oil byproducts: Occidental Petroleum, Shell, and Exxon. If I asked you, sitting here today, if you invested in those 3 companies 5 years ago, what would be your ROI? If you just averaged, those 3, what would be your guess?
I have no idea. I have zero idea. I don't know what it was worth back then. I've never been in oil equities.
So again, and this is kind of where it gets back to, the more you know, if you will. A lot of people kind of make statements on the news that people just take at face value. But if you'd been an investor in these companies those last 5 years, you would actually lost money. And that's why people don't want to invest in these companies, because all they do is they take every single dime they have and they burn it into exploration projects. And as an investor, you're never rewarded. On the other hand, if you bought Apple 5 years ago, you would have, I don't know, I'll put up a chart on the screen, but you would have tripled your money.
Right.
So, and that's because they don't have the ability to control the market. There's too many players, and if they're not willing to do it, someone else comes in and they do.
Gotcha. Okay. So I guess what I was trying to get into from the oil segue was commodities such as like lumber, metals, wheat, all that kind of stuff.
Yeah.
That's the kind of stuff is really what I was talking about when I was saying commodities are plunging off a cliff right now.
No, for sure. An agreement.
All those commodities right now are plunging off a cliff, and with that happening, it's usually kind of an anticipatory signal for inflation, because a lot of that is obviously what leads.
Yeah, it's your input costs.
Right, exactly. And so that's where you have 2 very divided sides of the aisle, where one side is inflation is transitory, and the other side is there's absolutely no way. I mean, we printed way too much money. Yeah. There's no way to come back from it other than probably a hard rug pull into Volcker it.
Well, yeah, I mean, and I think what the Fed is doing is what the playbook they've kind of been using for the last 20 years, I would say. And that is basically with all these commodities, like I said, they're not fixed. So the Fed is printing money, hoping that these guys come in and basically drill more oil, mine for more gold, mine for more lithium, whatever the raw material, the hard commodity is. Food commodities is kind of referred to as soft. So whatever that commodity is, basically they're printing more money. And let's say we print 50% more money, they're not expecting 50% rise in commodities, because they're expecting that to spur more, basically mining and development, et cetera, et cetera. And so, which is why, again, as an investor, I typically don't recommend on a long time horizon to ever invest in commodities or anything like that, because just by definition, it's very hard to beat the market. Because as you're seeing inflationary stimulus, their natural reflex is to go out and to, provide more of whatever the commodity is, which eats into your actual real return.
Yeah.
So
just
and that's kind of how the Fed. That's kind of how I feel like the Fed was trying to get away with the transitory, but they went way too far. From 2018 to 2020, the M2 supply. We discussed this kind of in an earlier video. I can throw up a chart again, but the M2 supply literally looks like a rocket just taking off. Right. So they went too far, too fast, in my opinion, on this one.
So going back to the original point, if I've been noticing commodities going down, is inflation truly going to be transitory or is it not? Where I'm kind of falling on the fence in my own opinion, and granted I don't nearly have as much knowledge as Justin does. This is the view of a retail trader. I see this not being transitory. I see what we're going through right now as kind of like a little bit of a dead cat bounce, if you will. And I think I'll be the doom and gloom guy. I think the market is still in for some tough times. I'm still in general agreement. I do think though the longer that they can string this out. I think that's what's happening. I think it's being strung out as long as it possibly can to make it more of a softer landing. It's still going to be tough.
And if you go back to 2020 when all this started and Trump started issuing all these like stimulus checks and all this stuff, nobody wanted to listen to them, but I was basically stating like you have 2 outcomes. Either one is we're gonna have a great 12 months, 18 months, and then we're gonna have a big recession, or we're gonna have a great 12, 18 months, and then we're just gonna have like basically what Japan had, which they called the lost decade. And they called it that because they pull forward all the demand in the 18-month period, or their short window from all future years. And that's how they kind of basically paid it off was, no growth with inflation. 3-4% inflation or something like that could be the alternative that we might be looking at. But yeah, there's no way to eventually you have to pay the piper. And I think that's kind of what you're getting to.
Yeah, I think that
I'm in agreement with that.
That makes a lot of sense. And that's actually, so I completely forgot. That's a great example, the lost decade in Japan. Because right now the Fed's showing their estimations for GDP being like 0.1.
Yeah.
So if we continue down that pipeline where instead of seeing a 75-point hike, or instead of seeing that, we see like a 50-point hike, and we just continue to string this out with like 25-point hikes or 50-point hikes, that may be what we're in for, is just incredibly small GDP growth to where, like you said, it's just...
So, but no, I'm in agreement. Wrapping this kind of whole thing up as far as the commodity side goes, I'm in agreement. And just in general, where we're sitting at now, again, from a technical level, is we're kind of either are sitting potentially a little bit on a cliff a little bit, maybe like another 15% move, or kind of sitting in a valley where we might see, another 5-7% move forward. And I've seen a lot of equities are kind of sitting in this kind of comfortable trading range, if you will, waiting to kind of move one side or another.
Just waiting for a catalyst.
Kind of waiting for a catalyst, which is kind of, again, why going into last week I kind of saw us doing a little bit of a mean reversion. So you saw that from Megacaps. You saw that, again, kind of getting back to what you said with the RVOB. That's kind of stabilizing a little bit, your gas prices. And then the 50-day on the S&P was 39.20. We got close to that, the 50-day was 39.75. We got to 39.20, so we got close to that, kind of failed off and closed around the 3900 level, which if you go back, I want to say it was a month and a half ago, where we had that initial support where we rallied into, I want to say the 4100 level or so. That was the 3900 level, which again is kind of, so you're kind of having that previous support becoming your future resistance here. And kind of another thing I want to talk about last week, which I don't know if you have any opinions on this, because I know you worship at the Musk altar. But the whole Twitter saga.
I haven't been paying too much attention to his whole Twitter saga, other than what happened yesterday with him formally moving to cancel the purchase of Twitter. Honestly, I haven't been following it too much. I follow Tesla and SpaceX more than anything. Twitter, I understood his interest in it, but I haven't really been following this whole...
So the reason I kind of bring that up, two things. On the equity side, you have kind of an inverse correlation that started to develop between Twitter and Tesla as the deal was announced, and a lot of people never thought that he was actually going to go through to begin with at the 54.20 mark. You had a lot of people, when that deal was announced, actually buying puts on it, basically stating that this deal was not going to go through and the price was going to drop. So that's kind of one thing as far as the reason I found it interesting. The other thing, pulling it up, is the reason I never thought it was going to go through was twofold. A lot of the purchasing that he was going to have to use was tied to his Tesla equity. So in order to be able to purchase Twitter, he did two things. A, he sold a lot of Tesla, and B, he was going to lever a lot of Tesla for the purchase. Now, what I find interesting is two things. He's either saying he's not going to purchase it, in my opinion, because he either wants a lower price, and he just basically kind of like buying a house and then realizing you paid too much for a house. You're like, oh, I don't want to pay this. Well, that's kind of not how the system works. You signed a contract. That's one option. For all you conspiracy theorists out there, another option, the amount of Tesla he sold to fundraise for the purchase of Twitter was very, very large. I'm going to pull up the actual number right now. We'll throw it on the screen. But if he was going to basically raise that liquidity any other time period without like a certain reason, it would definitely raise red flags. So because he was doing it for an alternative investment, nobody kind of became alarmed, right? So nobody said, why is he selling tens of billions of dollars of stake in Tesla? I'm getting out too, right? Because he has to make filings every time he does this. Because he did it with Twitter, it was kind of like, what's this side project with Twitter? I don't really understand it, but it doesn't really affect Tesla, only in the sense that he's selling his shares, which is going to be a temporary pressure. So for all the conspiracy theorists, maybe his outlook was like, this thing's probably twice what it's actually worth. And the part that really makes it interesting, let's say this whole thing goes to court, right? He has to pay $1 billion breakup fee. The amount of money he saved by selling Tesla where he did is actually greater than the $1 billion breakup fee. So basically, by selling his Tesla, even if he pays $1 billion breakup fee, he'll actually own more Tesla if he turns around and reinvests it, because of basically how far it's fallen since that. So I conspiracy theory 101 for anybody who's interested out there.
I haven't heard that, but I wouldn't doubt it, and I wouldn't put it past him. He's a very, very smart guy. And I feel like when you have that amount of money, you can easily afford people to do this kind of thinking for you as well, and to plan all this kind of stuff.
Yeah.
So I don't know. I wouldn't.
So he sold $8.5 billion. So the exact dollar price of all his sales, nobody really knows right now. But if we make the math easy, let's just say he sold at 1,000, which might be a little bit higher than what he did.
No, he sold actually higher than that.
Okay, so it's down 25%. Right. So 25% on $8 billion, you're talking a couple $2 billion. Right. So even if he pays $1 billion breakup fee, he's out. He's still ahead $1 billion.
Right, and then not only that, he's still has quite a large chance of not even having to pay that $1 billion breakup fee if he goes to court and spends.
Yeah, he could basically just be a nuisance to Twitter.
Right,
yeah.
$2 million, and
And the other thing too is that it doesn't necessarily exclude the possibility of him renegotiating, like dragging this out 3 months, and then trying to renegotiate for half the price, which would be, if I was a Twitter investor, I would be extremely livid, to say the least, because all he's done is basically destroy company value in the last couple of months by creating distractions. You have employees that have, when all this was going on, they literally just haven't been doing anything for a couple weeks, because they're like, well, if he's coming in, he's probably just going to fire me anyway, so.
But he made a couple extra $1 billion.
Who cares? Yeah, yeah, exactly. So what am I doing here? I'll just collect my Twitter check until I get fired when Musk comes in. Yeah. Or he comes in and I just have to start working then. So it's been a huge blow for anybody who's been an equity investor in the company. But yeah, so I found that kind of interesting. Not invested or not. I don't have any dogs in the fight on this one. I just kind of watch them from the sidelines.
I day trade Tesla here and there. I haven't really been in it this past week, only because it had one of its characteristic breakouts to the upside. Over the past week, I think it was down around like 650 like a week ago, and now it's sitting at 750. So it's just one of those very typical Tesla breakouts. You never really know where the roof is going to be, but I do fully expect it to drop back down here shortly, probably the next month. I love Tesla, so this is nothing anti-Tesla. It's just a matter of how, if you pay attention to how the stock works, it has very extreme upswings and very extreme downswings.
Are you gonna get like a little Tesla model to put next to the picture of the family in the office? Is that the a little Cybertruck model?
Not a little model. I'm waiting for that full-size Cybertruck to show up. Been pre-ordered for over 2 years. So.
And just to shut the whole bot debate down, as if people are trying to say it's about bots, he hired, and first of all, he waived his right for review. So that's on you, Musk, for being an idiot. But the other thing too is, from my understanding, Twitter gave him access literally to every feed of every tweet that's ever been tweeted, and the ability to analyze it. So if he didn't do his research, that's on him. So the whole bot discussion, nobody in the actual financial industry actually believes that for a second. So just, don't bring that up. If you're,
I didn't know.
Yeah, that's a whole red herring. It's a completely waste of time. But so really it's a question of, was his motive to legitimately buy it, or was it just maybe he thinks Tesla's going to 400 and he got out, over $8 billion, $8.25 billion at $1,000 without raising any red flags.
Could be.
So
either way, it's smart.
Yeah. So yeah, and then kind of crypto. I discussed that in the last video. It's kind of something that I don't really have a lot of crypto investments myself, just full disclosure. I do indirectly through Block and like a couple other companies, but that's not why specifically I own them. Going into the weekend last week, I discussed kind of liquidity issues and kind of things to keep an eye on. Just quick breakdown, Celsius did have a covering, a massive deleveraging, if you will, a covering of their debt. So they put up a whole bunch of coin, and their now margin call number, I want to say, was around 5,000. Something really significantly lower to what it was entering the weekend, which again is why I think you saw a lot of crypto and related assets you had a massive amount of short covering. 2/3 of the contracts that were being exercised in the first few days were basically people covering shorts, because they knew that with the covering, you're probably not going to see any immediate liquidations, that week coming up.
Yeah, I saw ETH and BTC up like 15-20% over the last week, so it makes sense.
Yeah. And then kind of 22, just covering on that, 22K is kind of the level you're kind of looking at where, all right, things are kind of balancing out. You don't have you had a lot of short covering already happen. You kind of need a catalyst one way or another, I feel like, to kind of move it above that level or to move down. That being said, 22, if you look at just Bitcoin specifically, 22 is a very critical number, because if you can get through that, let's say you have a good report on Wednesday, you have it doesn't even have to be good sentiment. If you just go from awful to bad sentiment, a lot of times that's where you see your largest gains. So if you kind of see that happening, you could see it go from 22 to 30 literally in probably 3 days, 3-4 days. There's a giant air pocket there. You don't really have any resistance around 30, and then once you hit 30, you have a large quantity of individuals that's their average purchase price. MSTR, they're the largest holder. Their average purchase price is 30,700. I mean, they've stated they don't have plans to, but a lot of people. I want to say I read a number, and this is always variable. So I read a number like up to roughly 70% of people are negative below the 30K level. So you hit that 30K level, that's a whole different story. But if you can break through 22 on better sentiment, stuff like that, you might be able to see a little bit of a march.
Cool, good to know.
Yeah, so.
Awesome.
Levi, I kind of mentioned that too in my last video. They did the exact same thing. They beat this week, had gains for about 3 minutes and lost them. So that's kind of the story you're seeing.
Levi.
Jeans.
Okay.
So they're one of the few companies that reported last week.
Okay, so just a little bit of an earnings review.
Yeah.
Okay.
Kind of recap on that one, and then kind of going forward. I don't know. Do you have anything to last few weeks as far as real estate that you're kind of keeping an eye on?
Yeah, quick little update. I am noticing that in my realm, where I deal with investors mostly as a wholesaler, flipper, builder, that investors are looking for a little more cushion in the deals that are being sold, right? So any deals that I come across where I find a home, get it under contract for a good price, send it out to what I think is a good profit margin for a flipper, they're actually looking for additional profit margin than what I've seen historically. A lot of that, I think, has to do with just the overall sentiment in real estate right now with interest rates going up, is since buyers are being pickier, flippers want a little extra security to know that they're going to be able to sell. And so with that, it is making the investment side, I wouldn't say tougher, it's just something we have to be aware about. So that way we know to get contracts at better prices.
It's kind of, would you call it more like a normalization or more of?
It's just
concern, or
people are seeing the market soften right now, and I think a lot of that is still this. There's an insane amount of demand, right? And the people that are buying are people, affluent people with 770 average credit scores, like we talked about last week. 20% of buyers, it was noted in 2021, were actually investors, right? So when you have so much money coming from investors that want to flip homes, own homes as rentals, whatever it is, when you see a softening on the investment side, it will affect the real estate market as well, since 20% is a sizable chunk. And so right now, just kind of seeing investors not necessarily back off, but just a little more hesitant, I would say. means going into investments or getting stuff under contract or flips ourselves. We're just double checking everything a little bit closer. That's really about it. I wouldn't say there's anything absolutely crazy critical happening. I would never stop investing. Every market is good for something, right? If prices are going down, rents tend to be going up. So it's a great time to be a rental investor as long as you can find properties at a great price. Flips, it might just be a tighter margin, but then you just have to get contracts at a better price. New construction is what I would be a little more wary of, where we're doing a new construction project right now. Granted, it's in a great area, and we have some exit strategies for that, to where, let's say we can't sell at the price we want to sell for, we're still going to be fine. So as long as you have multiple exit strategies, it's not a big deal. But it's, if you're inexperienced and you don't know how to get into new builds, now would not be the time.
So on that new construction, what are you guys doing? Are you looking at like kind of your average 1,800 square foot, or like what?
No, these are luxury. So like the one that we're building right now, we were going to do two, but we turned one into a wholesale, which means we just bought it in a dilapidated condition and resold it, just because the inflation we've gone through means we don't even have to touch it. We can basically resell it to somebody else who's willing to take the risk on building something brand new on the lot. So the one that we did pull the trigger on and are doing new construction on, we bought in an affluent area here in Orlando, Winter Park, and we bought a home that was severely dilapidated for $300,000, but it's very central to Winter Park, and we basically bought a $300,000 house just to tear it down. The thing is, our target price is going to be around 1 to 1.1 million. We can build for about 300,000 with the cost of the lenders and all kinds of other associated costs. There's probably, we'll give it another $100,000 in there just to be extremely conservative. So 700,000 basically gets us completely out to where we can pay all our debts and expenses and everything on there, and the profit margin should be anywhere from 300,000 to 400,000. Now, let's say with interest rates going up, that $1 million price point is pie in the sky, right? Let's say it's not going to happen because interest rates keep going up, the market's changing, it's going to get soft, people aren't really looking in the luxury market anymore. A year from now, who knows, right? It's a risk that we took. But at the end of the day, we have 4 partners, and one of our exit strategies, now this may be a very poor exit strategy, but to us, it's actually not a bad one personally. There's 4 of us, and to buy a 2,800 square foot house, brand new, 2 stories in the middle of Winter Park for $700,000, I wouldn't mind doing that at all.
Yeah.
Personally, only because I know, let's say you can't sell it at a price point that makes sense, I wouldn't mind buying it personally, getting the loan and buying it personally, because I know if I sit on that for 5 years, it's going to go right back up, right? As soon as we get out of this whole fluff with interest rates and whatnot, and the market just keeps going up, give it time, I have no doubt in my mind that purchase would turn into an easy $400,000 in equity.
Full disclosure, like I would never do this. First of all, you have to know what you're good at and what you're not. I would enjoy doing like reno projects, but to actually try a new build, I don't know that, with something serious like that, I would never undertake that project. So, again, just kind of know what you're good at, what you're not. And then the other thing is, full disclosure, you were a civil engineer for years. We went to school together. Yeah. He is a civil engineer. He's worked with, major corporations where they've developed entire subdivisions. So he's done this hundreds of times over. So the level of comfort there is obviously a little bit different than, jumping in and doing something like that. It's like when people come to me, sometimes people come to me and ask me about options. I'm like, well, how long have you actually been doing equities? Right. 6 months. Okay. Well, maybe you don't go from, from crawling to doing a 100-meter sprint in 6 months.
Why I don't touch options.
So,
he doesn't build new houses. I don't do options.
Yeah. So that's cool. That's good to know. Yeah. And that's kind of, like an outsider, that's kind of what I'd be expecting. You can't, where it was unsustainable. You'd have to have a return to norm at some point. And that's kind of, doesn't surprise me to hear that. Absolutely. But there's still, sounds like there's still plenty of opportunities. And,
Yeah. Florida's also a very unique market because, there's something every Floridian here knows. It's kind of like a stat that everybody throws around casually when they're talking about homes. Well, there's 1,000 people moving here a day. That number is actually way higher than that now. And Florida real estate, it's slowly turning into California, New York type style. Miami's already like that, but it's starting to spread. And that's something else that we're noticing is if the overall market US wide is seeing a softening in the Midwest or some other urbanized areas. We're really not seeing too much of that. There's a lot more price decreases that have been happening over the last month than have ever been happening. I review those daily, and I'm talking about I review 100 price decrease homes daily because I'm always looking for more deals. Those price decrease homes are homes that are very dilapidated, are severely cosmetically need a lot of work.
Yeah, I mean, the first video we did, we kind of mentioned this, but just to reiterate, if there's anybody new, obviously you guys go in, it's an all cash type situation because those are homes that the bank would not lend on. They're not livable typically. I mean, sometimes you do stuff that's a little bit more cosmetic, but a lot of times you guys are looking for something where, again, your expertise as an engineer and you guys as a team can go in and create value, if you will.
Right. But so these price decreases, just overall market wide, I'm seeing most of them actually on these homes that are just not nice. They're not ready for somebody to move into and not do a thing, right? So the homes that are like that, they're gone in a second. So it's really you just have to be careful of the headlines you read where people are saying, oh, housing crash incoming. I read that stuff and I kind of laugh. And people eat it up because they want it to happen so badly, because whether it's they haven't been able to afford a home or not, I hope that everybody can get into a home. I think it's one of the best wealth builders over time. But the thing is, unfortunately, I don't see the housing market going into some insane crash anytime soon.
It's kind of like when I see and I guess I'm in that community, so I make fun of myself here, but when people post $200 oil and an extra dramatic face on their thumbnail, I laugh and I just whatever. I keep scrolling, so just kind of
that's my real estate update.
Cool deal. Just looking ahead, this week, Bank of England, which a lot of people don't want to talk about, but outside the U.S. and China, they're probably the most important bank, and some people would say even above China. They're one of the most important banks in the entire world. They're going to be speaking on Tuesday, so as long as there's no major changes, stuff like this doesn't really matter. But with everything going on with the Eurozone, EU, if they and everyone here is complaining about the price of oil. These guys are literally actually feeling the effects of a war, unlike us where it's oh, gas is $4.50 a gallon. No, over there it's all right, do we have food this week? Or gas is $10 a gallon because we can't get any because Russia cut off our supply. So the way they handle the situation, people are kind of watching because you've seen a concern in the debt market as to how is this all going to play out. Are we just going to take billions of dollars of losses because of the way things going on with the ruble and Russian default? You're having countries that have less financial stability, some of your lower tier EU countries that are having, their interest margins are going up. So just in regards in that scenario, it's kind of important if they do something kind of out of left field and the EU zone, again, is the most important economy in the world. They're the most affluent. So they definitely, if something severe happens over there, we're kidding ourselves if we think it won't affect us. So just side note for that. You also have the New Zealand Bank doing an interest rate decision Tuesday as well. So kind of your global banks. CPI Wednesday, that's a massive thing. I'll kind of get into that in a second. And then we also have retail sales on Friday. As far as the CPI, again, getting back to what I was saying earlier, I think this is really what's going to be the market mover. Wednesday, it's needless to say, like I mentioned, we're sitting at a lot of technical levels. We're very close to the 50-day on the S&P. The 100-day is not too far above it. And then we also do have that 3,900 level that was prior support is now becoming a little bit of kind of a resistance / this is kind of what we're maintaining right now. So if you have a really surprise number on that one, which again, going back to your commodity discussion, I could definitely see us breaking through to the 50-day and maybe even breaking that depending on how good the report is. That's going to be the market mover. Everyone's going to be looking for that. Your volume last week was very soft. This week you're gonna pick up on your volume. That's how it's going to be. So that'll lead us to the last segment we got, and that's going to be flirt, date, or dump. So we're going to look at a few equities and decide what to do with them. All right, so the first one we're going to be talking about actually is Delta Airlines. So this one I am seriously looking at if I enter a position or not. I'm currently not. So Cons, your CASM, so that's your cost per available seat mile. It's basically how they measure the cost per mile flown. It's kind of an industry average so that you can compare between airlines and also use it as a metric when you're looking at just your costs in general for the airline. Those are expected to go up 19%. Net debt, because of everything that went on with COVID and all the times they were losing money, they're now sitting at $21 billion in net debt, which is larger than the entire value of the company. And there's questions about business travel, whether it's ever going to return or not, because of everything that people have digitized and gone to as far as technology with Zoom and all that kind of stuff. A lot of CEOs are talking about they're probably only expecting roughly half of their actual pre-COVID travel budget to be implemented going post-COVID. So with all that being said, I'm actually going to date this one. Now that sounds kind of crazy, but and the reason I'm going to do this, two things. One, I'm not actually going to buy the equity because of the debt value. If you have bad earnings calls, the floor is not defined. They're sitting at a level which is a 6-month low, which is another reason why I'm interested. Last earnings call, they're expecting $1 billion in profit this quarter. So positive. Again, they started talking about the business travel somewhat returning. You don't even need that to go back to 100%. I think if you're looking at this, they report on Wednesday, which is the exact same day that you have the inflation number. So again, this is why I'm playing at it from options, because I don't want to be exposed to the actual value of the stock. If it's going to move, I think it's going to move severely one way or another. And you've kind of, not to get too technical here, but if you look at the RSI, the relative strength index, and kind of the volatility within the actual stock itself the last few weeks has been coming down. And typically what you see before you see a breakout, either to the upside or downside, you actually see consolidation. So if I'm looking to enter a position, I'm going to kind of look at it Monday, and if we're trading slightly down to flat, I might buy a few options with the idea that if they have a good quarter, which I think, I don't see any reason not to, and I don't see any reasons for the guidance to completely fall off a cliff. Again, this goes back to sentiment's been really poor, but your data points have been good. You could see it hit 35 very easily. Like there's kind of a vacuum between 30 and 35, and then your next pain point is going to be at 40. So I think this one, going forward, I think you can play this a little bit of options. Again, you define your risk. If you have a $100,000 portfolio and you want to buy a couple grand options, knowing that this is kind of an all or nothing trade here, where this could probably expire worthless very easily, or you might double your money in a week. So just kind of knowing that volatility and that risk is very important for what you're trying to achieve. I personally am okay with that risk, and that's why I'm currently evaluating. I think this is one you date, but this is kind of like, I don't know.
It's a riskier one.
Yeah, it's kind of like the high school cheerleader. It's very chaotic. You don't want to be around for long, but for a week or whatever, like everyone gets to enjoy themselves.
You're gonna offend all the cheerleaders that are watching the video.
Well, we were all immature when we were 18, right? So the next one we're looking at, and this kind of goes along with the sentiment. And if you want something to kind of evaluate kind of on the safer side, PepsiCo. Everyone knows what Pepsi is. This one, it's very simple. I am not touching this with a 5-foot pole. Last 5 weeks, you've kind of seen a rotation in the market, right? You've actually started to see, as people start to think we might enter kind of like a slightly slow or slightly negative growth, and things aren't going to be completely cataclysmic, but we're going to have this stagflation. You've seen a rotation in the last 5 weeks. Small caps and high growth names have actually begun to outperform. So PepsiCo, you're sitting here at darn near a 52-week high. I think they're 3% or so off the highs. And as far as this equity specifically, would you rather? I'd rather own Coke anyways. Executionally, they're much better. So if you kind of want to maybe do a pairs trade where you're looking at something on the long side, but you want to cover yourself in case the market collapses, these guys, I think, are going to face resistance at 77. Might it break through? Yeah. I, however, don't foresee this. I think you're going to see that continued rotation a little bit out of this kind of like value basket or these like dividend aristocrat that has been garnering a lot of attention over the last 6 months. The last one I have for you, a lot of people might not have heard of, is actually United Health. These guys, if you throw a chart up of United Health with some of your biggest names in the industry, Google, Apple, 5-year chart, these guys stack right along with some of the biggest winners. but yet nobody ever wants to talk about them. It's really weird. I don't really understand. I don't understand what's going on here. I don't know if people hate healthcare.
Sexy.
Yeah. Hey, listen, 200% return is sexy to me. I don't care if you want to call it, Red Solo Cup Inc. You give me 200% return in 5 years, I'll take it. But these guys, I'm gonna kind of throw in the middle basket where I'm kind of in a Flirt category with these guys. I like the company. They executionally, they always do a really good job. They're one of the biggest players in the entire healthcare sector, which in the last 6 months has really kind of recovered back to its normal levels as far as market weighting and kind of stuff like that. If you'd gotten in January, you would have been a lot happier with yourself. But that being said, I think if you see a pullback on this one, the 450 to 460 level is kind of what I'm looking at. And I think that is kind of, if you want a little bit of healthcare exposure, that you can kind of start to begin to dollar cost average into. And I don't think you would be entirely mad looking back in 3 years from now, because these guys, again, are kind of one of your largest medical integrated companies on the actual exchange itself.
Okay, so a little bit more of a longer hold.
Yeah, and a little bit lower beta. So we kind of started with something that's, extreme beta, option type action. This kind of stuff is kind of one of the things where, again, you don't want to be, and I made this mistake myself, you don't want to go, too far in any direction, because even if you are right, and I did this with oil equities last year, I played oil equities through the option market, and I was 100% right, but my timing was off. So instead of making, potentially six figures, I lost a large chunk of money because they expire worthless. And that was me making the mistake of just over leveraging, if you will. If I'd done it through equities, I would have done great. If I'd done it through longer dated options, I would have done great. But just that 3 month time window literally ended right as the very next month after that expired, Schlumberger was up 30%. So again, that kind of gets back to where you want to have, when you're actually thinking of this as kind of like as a professional investor, you never want to go in all in, having all your risks exposed into any sort of category, whether that be one specific sector, that be one specific strategy.
So no YOLOs.
Exactly, no YOLOs. That's, yeah, yeah. So that's one I think if you look at, you kind of follow it. Moon. Oh yes.
GameStop to the moon.
That's right. You heard it here. 1200 post split first. That's right. No, actually, what was the crypto that you were in beginning of the year? That was
AXI,
yeah.
AXS. And then the whole crypto market took a dump, so that was tough.
But I forget, when did you get out?
I think that was like January. It started going down, and I was like, all right, this is enough. It like hit my like bottom, where I was like, this is the max I'm willing to lose. And I sold it. Yeah, sold it all.
Nice. I remember you telling me. You called me. I was for the record. I was trying to get him to sell it for like probably a month prior.
Yeah, it was doing well. And it was nice because I was staking. It's one of these cryptocurrency coins revolving around a game where you can stake it and make an insane return. It was like a 140% return over the year, and it was actually paying that out daily. So it actually wasn't bad. It was just, even though you're making that kind of return, the overall value was just kept going down because the overall crypto market was just not doing well. So,
yeah. GameStop to the moon. You guys have fun. Have a good week.